50 years to the Black and Scholes paper. Actually, June 73, the paper was published in the Journal of Political Economy. About a few weeks later, the Bell Journal with a paper by Merton. Actually, Bell Journal wanted to print before. Journal of Political Economy took more time, but he asked them to wait. He wanted to give Black and Scholes the priority in publishing the paper. So they published it actually 50 years ago to the date. So Menachem Brenner, professor from NYU, previously from the Hebrew University, and wrote many papers on options over the years, and he will give the initial presentation on the Black and Scholes and evolution of the model over the 50 years. Menachem, go ahead.
Buongiorno, ladies and gentlemen, cari amici. As Danny said, we are celebrating 50 years of the Black-Scholes-Merton model, a model that actually revolutionized even modern finance and created a huge industry. I will start my presentation, and I'm going to put it up now. And let me put on.
Yes, we see.
Yes, we see it.
Okay, you see it?
Yeah.
Yeah. So my presentation, the title is General, the Ultimate Financial Innovation, which I believe is the case. Unlike other people who, one of the famous Fed chairman who said that the cash machine is the ultimate innovation, but he just didn't understand about the options. And since I have to do, or I have to compress 50 years into 25 minutes, I decide that I will present briefly first the main contributions as I see it, and of course Danny and Zvi will complement what I said later. So let me put on what I see as the main points contributions. The Black-Scholes-Merton model is nowadays the dominant option pricing model. Any security, maybe except for bonds somewhere, what's plain vanilla, corporate securities, exotics, and so on, that is the so-called benchmark model. Of course, you make adoptions, changes, and so on, but that is the benchmark model. And that model was necessary for the main use, or one of the main uses, of options, which is risk management. And Danny will discuss that in detail. And the other thing, of course, is general, is the contingent claims approach, which emanates from actually the model applied across finance, and we will talk about the application in corporate finance. Now, another, in my opinion, big contribution is that it provides forward-looking information across financial markets. All of these will be detailed later, but this was the first time when the options came about and the pricing model came about that we now get a way to look forward rather than looking at information backwards and trying to forecast the future. So let me just very briefly, here is my outline. Of course, I'm going to skip some stuff and I'm going to be very short about certain topics, but I'm going to start talking about the size of the market, which in my opinion is a good indicator of how important the instrument is. I will go over the history of options so that we can learn how this evolved. I will mention other option pricing models and what their place is. of course, I call it practice. Danny will talk about risk management, the important area, and Sri will talk about contingent claim approach. Forward-looking information, some details, and how can I not update you guys with what's going on now in the markets as the information of implied volatilities. I don't think I have time for academic research, and the summary is basically going to be what I started with. So just to give you an indication, guys, this is a huge market, and this is global size. Of course, it combines here with, say, derivatives, also futures, but I emphasize, like, let's say, in red, the equities, which are in notional terms, 30 to 40 trillion. And there's some other numbers you can see at the bottom. But another measure, which is kind of up to date, is the following. It's the number of contracts in billions traded globally, and you can see that in the past 10 years, we went sixfold in options, and in futures, about almost threefold, which tells you how important this market is. There are other measures, of course, as we mentioned before, the notionals, and like open interest, which is, I think, about 1 billion contracts a day. And another one is an interesting measure, which is called the put-call ratio, gives us an indication to what extent is it being used by retail and institutions, when many institutions will be using it for hedging. And indeed, the put-call ratio in index puts is almost always larger than 1, where it's the opposite when it comes to individual stocks. So let's go over the history. Of course, I tried, so I can do it, kind of point out the main things and the milestones. So you will see wherever it's red or blue is important or more hard to say. I don't want to go over, of course, the past history. We go back to Aristotle mentioning options. But I mentioned Joseph de la Vega because it's a book you guys can read. And it comes out by the MIT Press. So they're all volatility, the use of options. Here is an interesting one that I found out a few years ago, and yesterday I reminded myself, is there was a guy in the 19th century by Russell Sage who uses hedging, who uses put-call parity the way we know, and you already get the elements of pricing of individual options. Now, the modern era, which starts about 50 years ago, actually came about. It was like world events happening. The fixed exchange rate system after Bretton Woods collapsed, and we moved from fixed to floating. Hey guys, we now have volatility in the foreign exchange market. Then we get the increase in inflation and volatility of inflation because mainly oil prices, and also volatility of interest rates. So now we get a demand for hedging, for risk management. And then comes 1973, and actually the CBOE, from what I understand, has started toying with the idea like several years earlier. And all of this comes together, we get the model published, as then mentioned. At that time, in June of 73, option trading starts April 26th, and the Options Trading Corporation also was then established. So you really get all the elements you need for a successful market. You get a central marketplace, you get rules and regulations, and you get a pricing model. I don't have time to get into it, But if you go and you look at new instruments, no new instruments in the long run is going to succeed if it doesn't have, of course, the need, the demand, and if it doesn't have some kind of a benchmark model that you can price that instrument. And of course, since we're here all together, I have to mention that Danny's dissertation was the first empirical dissertation using the CBOE data, and we learned much about it, and then I benefited from joining Danny and his research using this data. Another important thing, and Sri is going to talk about it probably, is the Merton model that was published in 1974. Another important step was index options that started trading in 1983 and has become actually the biggest options market nowadays, whether it's on the index or ETF on the index and so on. And in 1986, as many of you may know, Danny and I proposed that volatility index, which was the predecessor of the famous VIX. And God will tell you, give your advice to the younger guys, if you have an idea, put it in writing. Don't keep it in your head. So here comes 1987, October 19, 1987, and I happened to be at that time a floor trader in options on a subsidiary of the New York Stock Exchange, so-called New York Futures Exchange. And before the crash, we were pricing options with a slight small due to stochastic volatility jumps and so on. By the way, on that day, the implied volatility was about 100%. After the crash, the skew was born, and it's now a phenomenon which is worldwide, which means that we price put options, out of the money put options, relative to the at the money higher and out of the money call options low. And I just showed you, the next slide. Here is, you have on the right-hand side, you have how the skew looks like, which is just across strike prices, and then across maturities, you get turn structure, which at that time, when I took this picture, happened to be much higher than the long on average, so you had a downward sloping turn structure, which is opposite to what we have right now. And on the left-hand side, it's called the surface, which is the combination of the two. Let me mention one more thing about the crash, which contributed to the trading of options is actually, in some sense, I would say, the collapse of the dynamic trading strategy called portfolio insurance. Portfolio insurance was big before we came to the crash, and then in the crash, it actually failed because the assumptions didn't hold and so on. I'm going to get into the details, but that contributed to an increase, if you wanted to hedge, in the use of options. Let me chart forward. At 93, the CBOE is launching officially VIX. And by the way, at the same time, interesting, the MX launches the first ETF, which became, as you know, a huge market. So let me move on to the 2000s. Aside from saying that the CBOE is now using what's called the Goldman Sachs methodology for VIX, and it's actually the dominant methodology across the world. An interesting introduction was electronic trading of options with market making by this new ISE, the International Securities Exchange, and actually it turned out to be the winning model. Just for your interest, nowadays there are about 60 plus venues to trade options. I'm talking about the United States. And another important point is options, futures, ETFs on VIX are trading at a large volume. Maybe I should mention for
We don't hear you.
That in February 5th, 2018, people who were essentially selling volatility and were in these ETNs were just basically wiped out. So careful when you sell volatility. Option pricing markets. Black-Scholes merger, as I said, is the dominant one. There are surveys from time to time by some institutional investors. What is the proportion of options being used? Guys, there's no doubt 90%, 95%, that's the dominant benchmark model. I'll give you one example. I've been on some consulting boards. Employee stock options, everywhere you go, are present Black-Scholes. You ask the people who on the boards mention that and so on, they say, oh, yeah, Black-Scholes. I have no idea what it really means, but that is, as far as I know, the dominant pricing model. I want to mention something about exotics when we talk about what comes first, the industry or academia and so on. Of course, it goes back and forth, but exotics is a good example. The paper, the Bell Journal paper that Danny mentioned by Merton, has a small section, closed form solution for down and out options. This is 1973, before the industry even was thinking about using these options, which came years later and became a big industry. Now, the binomial model, some people call it maybe the mother of all models, because, by default, it could be the Black-Scholes model, go to the Black-Scholes model, or even more than that, when it's like path dependent, you can use it, and of course it's being used. People could talk about it, it's being used for valuation of startups and projects and so on and so on. The other models that you see here have been tried from time to time, but eventually abandoned, or I don't know if many who use these models. The simple reason is that too many parameters to estimate, and they're too unstable, and basically go back to the Black-Scholes model about Monte Carlo simulations. I will not talk now. That's for another time. So, by the way,
Menachem, you have 5 minutes.
Okay, I have your papers, I should mention before. All the issues, the Black-Scholes model, there's so many issues that conflicted with the assumptions. We still use the Black-Scholes model. And I said the last contribution, forward-looking information, and here is a list. And I'm not even talking about information derived from football parity, which is basically current information. Here we're talking about forward-looking information. Let me just mention, implied risk attitudes could be derived. Okay, risk attitudes could be derived from there. And even correlations. Of course, in these two specific cases, you can estimate the correlations based on implied volatilities. And as I said, I'll mention just a few. This is the latest update that I have using VIX and so on. And you can see VIX nowadays, amazing. Sometimes people say, look, the uncertainty is so big, but VIX is still less than 15%, around 15%, which is way below the long run average. But this is also, we see it at actually realized volatility, which is the next page. But remember, VIX is a 30-day volatility. And you can see that the term structure of volatility, when you look at the futures of VIX is really upward sloping, which people think it's not going to be in the long run. And I'm going to skip that. I thought it would be interesting to show you, this is now April 21, 2020, when oil prices went negative, an unusual phenomenon. I've never seen such a high, maybe in the individual options sometimes, but in the futures market, such high implied. And the last one, which I thought is a very interesting thing information that we got, was before the 2020 election in the United States, we got a kink in the term structure of volatility. So the term structure of volatility was upward sloping until before the election. So there was big uncertainty, Trump, Biden, whatever, and then come the other November, the futures of November, December were lower because resolution of uncertainty, and look at that compared to the other elections. So this is interesting information that you could have never derived without options, and actually this is based on the actual model because VIX is computed from there, and futures and options are traded on it. So I'll leave that talk about research for next time, and I'll just stop sharing and just say, guys, let's go back to the page of the summary at the beginning. The contribution of the Black-Scholes model is overwhelming in basically all areas in finance and maybe in business in general, even beyond finance. So this is an important area. I don't know of any area in economics that we have a model which is so dominant, so affecting the area in economics. And I will now turn the floor to my friends, colleagues, Danny and Svi, and I'll be sitting back with it.
Thank you very much.
Questions there are, I will entertain.
Yeah.
Thank you.
We'll have questions at the end of the session. Thank you very much. And only to mention that Menachem is now engaged in research on ambiguity, which is a second sort of the VIX, the volatility of the VIX as an indication of the ambiguity.
So let me, just because he's serving as a moderator now, I'll take for a moment the role of moderator to present Professor Dan Galai. That will give us a speech, BSM and the evolution of risk management. Professor Dan Galai doesn't need to any presentation, but just in case, he's a professor of A.B. Gray, professor of finance and business administration at the Hebrew University of Jerusalem, known for his contribution in the field of financial engineering and risk management. He made significant advancement in theory and practice of financial derivatives, risk management, and corporate finance. Some of the notable aspects of Professor Dan Galai works comprehend the co-creation of the VIX index together with Menachem Brenner, risk management and derivatives in general, corporate finance, capital structure, corporate risk management, real option, financial innovation, among the other. Please, Danny, the floor's
Thank you very
yours.
much.
We have 25
Few
minutes.
personal notes. It's really exciting after 50 years being involved in research on options. But first of all, I have to mention that my great uncle was a professor in Florence in 1910, and later on he was among the founders of the Hebrew University. So that's a connection that we make. Okay. Okay, so that's the content. We'll try to squeeze into 20, 25 minutes. Going the wrong direction. Okay, so first of all, you should know that research in options started before Black and Scholes. And actually, if you look at the paper by Bones, and again, one note that I forgot to tell you, Mario Scholz was supposed to talk to you, but because of timing schedule, he's now flying from Singapore to California, so he couldn't attend it. But he really want to be here, at least by Zoom. Okay, so research started years before Black and Scholes. Paper published, dissertation published by Bones at the University of Chicago. If you look at the formula, it looks identical to Black and Scholes, with one small difference. The discount rate in the Black and Scholes, as you know, is a risk-free interest rate. In his formula, it was the expected rate of return on the underlying security. He used the same assumption, perfect capital market, log normal distribution, and he used the log normal distribution in order to achieve the expected future value of the option and discounted it by the cost of capital of the company, of the underlying stock. So it looks the same, but you get completely different answer. But if you take the n of D2, of minus D2, you get the probability, the true probability of bankruptcy. And we will talk about it later on. Okay, so it looks the same. There was another paper, Sprinkle and some additional papers. Also, Merton and Samuelson were working, trying to solve this issue. It was really the breakthrough of Black, Scholes to some extent, and Merton doing the hedging. You see, the problem is when you take the discount rate, like Bones did, it's a mistake. It's not the discount rate for the option is not the discount rate for the underlying stock. That's what he assumed, Bones. And the secret was really to neutralize the risk by continuous hedging and then to use the riskless interest rate as the discount rate. And they got the hint from Merton and some other mathematician at MIT, to use a heat transfer function in order to get the closed forms solution. And that was really the major breakthrough. Okay. I was fortunate enough to be at the right place at the right time, writing my dissertation at the University of Chicago. And when I found an obscure dissertation in 1970-71, which attracted my attention to options. Nobody was talking about options at that time. I'm talking about 1970, 71. And it so happened that I wrote a paper on put-call parity. We got data from Hans Stoll, who did the first paper on put-call parity. We did the empirical study. And at the same time, I was told that the CBOE is planning to open an option exchange. And also, more or less at the same time, 72, 73, Black and Scholes came to Chicago. So it was a fantastic coincidence to have fresh data, because some professors from Chicago were involved on the board of the Board of Trade and the CBOE, Chicago Board Options Exchange. So I was fortunate enough to get shoebox with cards every month with fresh data from the initial 6 months of trading, and to use it in order to try to measure market efficiency, but also the validity of the Black and Scholes formula. So it was, as I said, a fantastic coincidence. In August 75, after finishing my dissertation, I did some consulting work for the CBOE, working on an index for options, which they call GOI, Galai Option Index, which is also another meaning. But it it was really the idea of standardizing option for 30 days, always at the money. That was the basic idea behind the index for options. I published a paper in the Journal of Finance in '78 by the title Index for Option. Then, in the early 80s, as Menachem mentioned, in '83, they start trading options on the index, on the Standard & Poor 100. And with Menachem, we suggest to the exchange, initially to the American Stock Exchange, and later on to the CBOE, to have an index, which we call Sigma, index on the volatility, by using the implied volatility. So that was the beginning, actually the first draft we prepared for the American Stock Exchange in 1986. The head of the new product committee was Bert Malkiel from Princeton. They didn't know how to hedge it. We spoke to many market makers. It didn't. At the end of the day, they decided it's too risky, too complicated. They postponed it or delayed it or rejected it. So we went to Chicago. Menachem and myself, we went to Chicago in August '87. They liked the idea, but then came the crash in October '87, and they froze all new plans. Only to mention that the CBOE started calculating the index from '93 and took another 10 years to start trading the futures and then the options. Okay, now Menachem mentioned also the history, so most of you weren't born at that time, so you should refresh course on history. Actually, from at the end of World War II, Bretton Woods Agreement, fixed exchange rates. Also, the monetary policy was to fix interest rates. There was hedging, no need for hedging. Actually, it's hedging, and costs incurred by the taxpayers. It all changed toward the end of the '60s. United States went off the fixed exchange rate. The disciples of Milton Friedman came to Washington, D.C., and they started to change the policy to fix a money supply, 4% of Milton Friedman, to those that studied Milton Friedman, to allow interest rates to move as the price of money. So suddenly, in the beginning of the '70s, FX, foreign currencies, were pretty volatile. Interest rate was volatile, and then commodities from '73 on became very volatile. So the title in Business Week was A Casino Society. But the markets reacted by opening many exchanges. So the first exchange was the CBOE. But immediately after it was the EOE in Amsterdam, then in London, Paris, New York, and within about 10 years, more than 100 new exchanges were opened all over the world. So that was a response of the market to the increased volatility by proposing instruments to volatility, on uncertainty, in the different segments of market risk. And in parallel, the OTC market grew, Menachem also mentioned it, up to $700 trillion before the GFC. Later on, it went down a little bit to 600 trillion, still huge numbers. So we have traded options and OTC options side by side as instruments for hedging risks, but also being able to buy risks. And that's okay. We're talking about risk trading. And by the way, as a response to the increase in the OTC market, to a large extent, the BIS, Bank for International Settlement, started to regulate. It was also the international competition with Japan and different capital adequacy requirements in different countries. So the first draft of the BIS was in '88 to start regulation from 1992 concerning credit risk. In 1998, they introduced a regulation on market risk. And actually in 1998, it was the first time that regulators allowed using the Black-Scholes formula for capital requirements, because allowed evaluate risk only in 1998 for sophisticated banks, advanced calculation. They allowed for using either the binomial model or the Black-Scholes for calculating the fair value of derivatives. Okay, so when we buy any instrument, financial instrument, real estate, whatever, we buy a distribution, future distribution of values. And what options are doing simply is slicing the distribution. Slicing in such a way that we can trade each part of the distribution that we would like to. And with strategies, we can also manipulate or take some parts of the distribution and get rid of the rest of the distribution. So it was really, that was a breakthrough, the ability to price slices a given distribution. Actually, it gave rise to new strategies like portfolio insurance, of a LOR, if some remember LOR, Leland O'Brien Rubinstein from 1985 until the crash of 1987. Also an interesting paper that came in '78 by Miller, from the Modellan Miller and Barnes, a PhD student of Merton Miller, to price contingent claims. They suggested to take options on S&P 500 or 100 and to price the different slices, as I said, and then to decompose or recompose them in order to price any uncertain instrument based on the market index. So it was a new approach, interesting paper from the 70s. And also Richard Buchstaber, among the pioneers in option pricing and research, the few books, and also showing how you can shape distributions of any given distribution by using options. So actually options allow us risks, to mitigate risks, and to open up a market, new markets, for risk management. So as I said, Mark Rubinstein and Dylan from Berkeley took the idea of insurance and proposed a new program in 1985, very interesting, for insurance to pension funds. They told pension funds, consistent with a utility function of your saving partners, okay, by truncating the tailed distribution. But since pension funds are long-term funds, so they proposed to create put options for 3 years. They were not, you couldn't trade on the exchange options for 3 years. Options were up to 9 at that time. Okay, so what they did synthetic put options by using the Black-Scholes formula and by trading futures using ND1, the parameters from the function, to create synthetically a put option in a dynamic strategy. They were careful not to call it insurance, but they called it dynamic hedging strategy. It worked beautifully well until the crash of '87 in October, when the market fell in one day by 22%. What happened then? And by the way, volatility went to 100% annualized. See, they were not in insurance program, but dynamic hedging. In the contract, they wrote that they will maintain it as long as the market is not moving by 7% up or down. Since it went by 22%, they stopped the program. Actually, some that mimicked them and did the same succeeded very well, or 2%. They protected the portfolios extremely well. But they stopped at 7% and continued the full hedging, and they had all kinds.
You have to turn like this. Yeah, 5 minutes. You have to turn the mic like this, otherwise it's not working. Turn it like this.
Better?
Yeah.
Good. Okay. The option pricing model is used also in corporate finance, and Zvi will talk about it soon after. And we have embedded options in so many contracts, which again are affecting the riskiness of the contract and the risk management tools that we have. VIX and risk management. Okay, so the VIX that we mentioned, we proposed it initially in '86. What we suggested is to take the standardized option based on the index, to use only close to the money options. We didn't like the smile that Menachem mentioned. So we thought that it's sufficient to have, we have so much liquidity in index option close to the money, and you get much more reliable, less noisy estimate. So you calculate the standardized option that is always 90 days ahead, always at the money, sorry, 30 days ahead, always at the money. You invert it and implies the standard deviation. What they used later on is a variation. They calculate the implied volatility for each series of options and did the averaging. It's much noisier. I think that our approach was much cleaner in this sense. So it's measuring, it's the only measures that we have in statistics, in series analysis, time series analysis, that is forward-looking. When we did historical deviation or any research that you do in economics, you use past data. The VIX was the only index that was forward-looking. Why 30 days? It was arbitrary. Today, everybody's using 30 days without knowing why, but at that time, when I suggested the index option, we had options for 3 months, 6 months, and 9 months. And the 30 days was sort of like the minimal that we can use for extrapolation. Extrapolating the two nearest option series. Okay. So here you have the behavior, and it's really very good indicator of where the markets are, what is the sentiment in, and it's very useful that tons of research done on volatility, integrating it. Today also the Fed is using the VIX as an indicator of the economy. One of the sort of the state of the economy is being measured by the VIX. From our experience, we find it to be very useful. Here you have the term structure that Menachem also mentioned, but for specific day, September 19th, 22. And by the way, historically, during normal times, the VIX in the United States is about between 10 and 15%. But in recent years, since the COVID, it stayed above 20 for most of the period. And in many months, it went to 30%. And that's much above the long-term average. So we expected some convergence. Okay, the last one, we'll talk about regulation and accounting. And again, it's the usefulness of the option price model for pricing financial risks. And as I said, it's acceptable by the BIS for bank regulation for determining how much capital banks must hold against market risk. It's also, to some extent, acceptable under Pillar 2 of BIS for credit risk, so we will talk about. But also accounting-wise, today, accounting rules for market risk, you have to report in certain ways on your exposure to market risk, which is equity, commodities, FX, and interest rates. And many corporations, if you look at the report, the annual report, you'll find that they provide the value at risk of the option position as part of the reporting. So today, it's acceptable accounting-wise, very useful for any risk management, and it's really the ability to decompose or aggregate different risks. So in 50 years, done, a lot is to be done. Let me mention one anecdote. When I wrote my dissertation, towards the end, Fisher Black called me to his office and said, Danny, actually, there's nothing to do in options because Myron and me, we already did the valuation, we did some empirical work. The only work left in option is volatility estimation. He was very concerned about volatility estimation. He said, that's the only, everything is solved. So do only volatility estimation. It was towards the end of the dissertation, I did the market efficiency and validity of the model. But later on, I continued to work on volatility. And yes, to some extent, he was right. But still, I think that thousands of papers were written since 73 using the concepts which were founded by Black, Scholes, and Merton. Another small note, personal note, when I wrote my dissertation and I wrote BSM model, I was asked by my two advisors to omit the M. They said, the M is out, it's only BS. Later on, they changed the mind, and today, with a step by Myron Scholes, that it's okay.
Thank you. Thank you, Danny. Academic competition as usual, no? I mean, it was interesting to listen from your experience during the period. So this is a historical perspective that sometimes we miss. Thank you, Danny, for your speech.
בסדר.